The Bank of Canada is holding off on increasing the interest rate. Is that really what's going to happen this year? Several economists and leaders in the finance industry believe this is the right move to balance out the Canadian economy. But what does it mean for anyone looking to buy or sell their home? In this video, I'm going to be giving you some background on what the Bank of Canada does and how they impact interest rates and what that means for home buyers and existing homeowners. And more importantly, what is going to happen with interest rates for the rest of this year? And before we get into it, if this is your first time here, welcome to my channel. My name is Fred Tam and I bring you the best real estate tips and market updates to help you reach your real estate goals. We also have a goal to help as many people as we can by keeping you informed of what's happening in the market. So please subscribe to the channel and help us reach that goal while helping you reach yours. Okay, so what is this interest rate and why is it so important? It keeps going up, but what does that actually mean? Here's some background on what the Bank of Canada does and how they impact the real estate market. While the Bank of Canada doesn't decide what mortgage rates are going to be, they do have an impact on them when they change what's known as the policy or key interest rate. When the economy is strong, they might increase the rate to keep inflation from rising. This discourages people from getting mortgages or other lines of credit, and a lower ability to borrow money means lower demand for housing. On the other hand, when the economy is weak, they might lower the policy rate to keep inflation from falling. Now, the banks also reference the policy rate as a baseline to decide what mortgage rates are going to be, which means that whichever direction the policy rate goes also has an impact on home prices. So rates essentially go up to get people spending less, which means people are not buying houses anymore. And when rates are low, it's easier for people to spend on big purchases such as a new home since it's cheaper to get a mortgage. And during the early days of the pandemic, almost exactly 3 years ago, the banks were quick to cut interest rates. This helped lenders to supply credit to households through different types of loans and mortgages. Since March last year, the policy rate went through 8 consecutive increases in just 11 months to 4.5%, which, by the way, is the highest it's been since 2007. The next announcement is set for March 8th when they might make another increase, but this might actually not happen. After the rate hike in January, the central bank indicated a pause on further rate hikes to review how the economy is responding. The director of economics at TD Bank, James Orlando, says that although the Bank of Canada has the option to increase the rate again, the expectation is to hold rates at the current level for most of the year. If rates stay the same or even go down, let me know in the comments how you think this might impact home prices, and if you're finding value in this video, give it a thumbs up. We know that some home buyers and sellers took a pause over the last few years for two main reasons. The pandemic caused a lot of fear, doubt, and uncertainty, and also now because of increasing interest rates. While sitting on the sidelines, the time was used to assess for themselves when is the best time to get back into the market. Buyers are obviously waiting for prices to go down, and sellers are worried about their home values. But if we know that interest rates are going to remain flat or even begin to come down this year, then the market could start seeing a pickup in activity, not only because of interest rates, but also because it seems like home prices are no longer cooling down. Canadian average home prices peaked in February last year and came down 23% in July. Home prices are still floating around what they were more or less half a year ago, and in Toronto they're actually higher in certain communities when compared to the last few months. And one thing to keep in mind right now is that the market is less competitive compared to what we saw last year. We're sort of in that transition period from a buyer's market that could eventually climb back into seller market territory as it normally does. Stephen Brown, the Deputy Chief North America economist, says the rate hike we saw in January is likely the last one, with the bank potentially cutting rates as soon as July. This could create a shift in the real estate market if rates remain where they are throughout the rest of this year, or even possibly come down. Because if a buyer knows that the interest rates are not changing anymore, it would prompt them to be more active again in the market, since waiting and trying to time the market could see them facing increased competition and possibly higher home prices. But be cautious, because the full impact of these rate hikes have not been realized yet, and it could take the rest of this year to see them. For homeowners with existing mortgages, their monthly payments didn't become more expensive during the pandemic because they either had a fixed rate that wouldn't fluctuate or variable rate that went down. But over the last year, as rates went up, those with variable rate mortgages have also seen their payments go up and are maybe feeling the pressure from these higher payments. And I talked a bit more about this in another video. If you're curious to see what mortgage payments look like relative to home prices over the last year, check out the video by clicking the card up top or in the video description. 53% of home buyers who took a mortgage and those with loans to renew chose a variable rate mortgage in the last half of 2021. That's when the prime rate was 0.25%, which meant the cost to borrow money 2020 was much lower back then. And throughout the last 11 months, that group of 53% of people were hit with increased monthly payments. There's also another group of borrowers who have loans that started 3 to 5 years ago that might also start feeling the impact this year, because it's likely that a lot of people lean towards a mortgage term of 3 to 5 years, so they would be due for renewal at current market rates, which are much higher than what they were used to paying before. And if these two groups of people cannot support these higher payments, then we could see a slight increase in housing supply for this reason as well. The last few years in real estate have really been anything but normal. I think this year is going to be no exception. Like I mentioned earlier, we're already in that transition period. We are starting to see some balance in the real estate market. And to be clear, balance in the Toronto real estate market usually leans towards the sellers. They play a role in controlling housing supply. So if supply is limited and demand is still there, then it does make sense that we could see rising home prices as early as this year. If you're a homeowner or a potential buyer or even someone who's just been watching the market, let me know in the comments if you think the Bank of Canada should continue to raise the key interest rate. I hope you gained value from this video and learned something new. Don't forget to subscribe and share this video with someone that you know. Thanks for watching, and I'll see you in the next episode.